The way silver is traded has shifted in a significant manner, not in terms of the instruments being used, but in the fundamental approach and execution. To understand this shift is to understand why the coming period may bear little resemblance to the past several years. This discussion is not rooted in theory or conjecture. It is built upon a foundation of legal settlements, regulatory actions, and a growing divergence between the paper market framework and the tangible realities of physical supply. The tactics, the numerical evidence, and the potential breaking point all point toward a system under considerable strain. It is important to grasp the implications of this situation. For a long time, the valuation of silver has been less a function of the actual metal and more a product of paper contracts that derive their value from it. When the supply of paper is effectively unlimited, the constraints of physical supply can be ignored, but only up to a point. There are 4 specific methods historically employed by major institutions in this market, each supported by legal findings. These methods exist alongside a persistent supply shortfall, creating a timeline where the existing structure must either adapt or face a more serious disruption. This is not speculation. It is a matter of record. The methodology for this analysis involves reviewing court documents from several notable cases. These include the settlement involving JP Morgan for spoofing activities, the settlement with Deutsche Bank concerning silver price manipulation, and the extensive documentation from related class action proceedings. This legal evidence was then compared with data from regulatory reports on futures market positions, inventory levels in major exchange vaults, and supply and demand forecasts from industry groups. The focus is not on commentary or opinion, but on admissions made in legal settings and numbers reported by exchanges and regulators. This process reveals 4 recurring tactics that are evident in both the legal record and observable market patterns. The first tactic involves the leverage of the paper market. The volume of silver futures contracts traded vastly exceeds the annual global output from mining, with annual mine production around 850 million ounces. The paper market sees positions that represent a multiple of that figure. This creates a synthetic impression of abundant supply, an illusion that has historically been the primary determinant of price. The second tactic is the timing of selling pressure. Legal documents and trader accounts describe a pattern of large sell orders being executed during periods of lower market liquidity, often with the intent of preventing prices from rising beyond certain thresholds. Historical analysis shows this has occurred with statistical regularity at key price levels. The third tactic encompasses spoofing and coordinated activity. Settlements have included internal communications between traders at different institutions, revealing the use of coded language and references to specific times for executing orders. Spoofing, the practice of placing and then canceling large orders to mislead the market, was employed systematically. The fourth tactic focuses on options expirations. A repeated pattern shows sharp price movements around the dates when options contracts expire. The mechanism is clear. Influencing the price to settle below a critical level can cause many contracts to expire worthless, benefiting the sellers. These observations are reinforced by additional data streams. The collective short position held by major institutions in the futures market is substantial, representing a significant portion of annual mine production. At the same time, the physical market has been in a persistent deficit for several years, with demand consistently outstripping new supply. Inventory levels in the vaults that facilitate trading have been declining, with reported withdrawals at times being very large. The available physical stockpile readily accessible for trading is notably thin, especially when contrasted against the scale of the paper short positions. This illustrates the core mechanism and its growing vulnerability. Typically, the price is set in the futures and over-the-counter markets where contracts are mostly settled in cash, not metal. This allows for large short positions to be established without immediate concern for physical delivery. When prices rise, increased paper selling can create the impression of ample supply, calming the market. This process functions smoothly as long as 2 conditions are met. Most participants accept cash settlement, and there is enough physical metal available to satisfy the minority who do request delivery. The change now is that physical demand has increased structurally, particularly from industrial uses like renewable energy and electronics, while available inventories have shrunk. This creates a tangible problem. If a significant portion of paper contracts were to demand physical delivery, the institutions holding those short positions would face difficult and costly choices to obtain the metal, undermining their ability to manage price through paper tactics alone. The arithmetic is straightforward. Mine production is relatively fixed in the short term. The paper short position is a large fraction of that annual output. The market is already drawing down existing inventories to meet a multi-year cumulative deficit. If the rate of inventory withdrawal continues or accelerates, the buffer that allows the paper market to operate smoothly diminishes rapidly. The key variable to watch is physical inventory. If vault stocks continue to fall without meaningful replenishment, it confirms the physical draw is intensifying. The timeline for observing this stress involves several pressure points. In the immediate term, monitoring the inventory and exchange-registered vaults is critical. The pace of withdrawals will indicate whether tightness is increasing. Over the next few weeks, the ratio between gold and silver prices is another important indicator, as a historically high ratio may signal undervalue. In the medium term, the market's behavior around key historical price levels will be telling. A successful test of those levels without the customary suppressing sell orders would suggest a change in dynamics. Confirmation of increasing stress would also come from sustained price premiums for physical silver bars and coins in the retail market, which indicates scarcity. It is useful to separate what is known from what is implied and what remains conditional. The facts are well documented, substantial regulatory settlements for market manipulation, a verified multi-year physical deficit, declining exchange inventories, large reported short positions, and an elevated gold to silver ratio. These facts imply that the traditional paper-based tactics are under greater strain than in the past. The physical market is showing signs of scarcity that paper selling has not been able to mask completely. If this continues, the institutions with large short exposures may eventually be forced to adjust their positions, which would itself create upward price pressure. Conditional scenarios depend on specific triggers. Should registered inventory fall to a critically low level while physical premiums surge, it could indicate an acute shortage, potentially leading to a rapid price adjustment. Alternatively, a decisive price move above a key psychological level could trigger momentum buying and short covering. However, if mine output increases or inventories are replenished significantly, it could alleviate the immediate pressure and lead to a period of consolidation. The significance of the current moment is that the condition which allowed paper tactics to work effectively for years, ample physical inventory to backstop delivery demands, is a industrial demand is structural and less sensitive to price fluctuations. Investment demand has shifted toward forms that require physical metal. Mine supply is not growing quickly enough to close the gap. The breaking point is not a specific event, but a condition where paper market actions can no longer suppress price because the physical market cannot provide the necessary metal. The market is closer to that condition than it has been in over a decade. In plain terms, the physical silver market is in a structural deficit with declining visible stocks. The primary mechanism that has historically suppressed the price is under increasing stress due to this physical tightness. The institutions that have large short positions will eventually face a decision that could be bullish for the price, regardless of which path they choose. Important levels to observe include near-term resistance points and longer-term psychological benchmarks. These are not predictions, but potential outcomes based on the trajectory of the data. The risks that could alter this trajectory include a sudden increase in mine supply, a sharp drop in industrial demand due to an economic slowdown, or large-scale disposals from official reserves. These risks are real but represent potential offsets, not the current reality. To summarize the observational timeline, focus on several key areas in the coming weeks and months. Watch the weekly inventory reports from major exchanges. Note any widening premiums for physical metal. Observe whether the gold to silver ratio begins to normalize. Pay attention to how the market behaves at historically significant price levels. Monitor regulatory reports on market positioning for signs that large short positions are being reduced. These data points will provide confirmation of whether the stress is building or abating. In closing, for more than a decade, the price of silver has been heavily influenced by a paper market that created synthetic supply. This mechanism functioned because the physical market had sufficient depth. That depth is now diminished. We are witnessing a growing divergence between the paper structure, which suggests abundance, and the physical reality, which indicates scarcity. When such a divergence persists, the physical reality ultimately prevails. The tactics used in this market are a matter of public record, confirmed through legal proceedings. Their effectiveness, however, is now challenged by a physical market that cannot comply with the paper narrative. The signals to watch are inventory levels, physical premiums, and price action at key levels. This is an analysis of market mechanics under structural stress based on documented evidence. The interpretation of this information and any actions taken are matters of personal judgment. A critical and often overlooked aspect of this dynamic is the role of the futures market structure itself, specifically the process of contract rolling. Each month, holders of expiring futures contracts must decide to either take delivery of metal or sell their current contract and buy a later dated one. This routine activity is typically where the paper market exerts its quietest yet most persistent form of control. When banks hold dominant short positions, they can influence the pricing relationship between monthly contracts, making it financially unattractive for longs to stand for delivery and instead pushing them into the perpetual cycle of rolling forward for cash settlement. This mechanism has successfully diverted physical demand for years. However, when physical scarcity becomes pronounced, this structure can invert. The cost of rolling contracts can shift, and the premium for immediate metal, known as backwards, can appear and persist. This is not a common event and signals that the market prioritizes present metal over future promises. Observing the forward curve for sustained backwardation is a technical confirmation of the physical tightness described by inventory withdrawals. Further compounding the pressure is the geographical dimension of the physical deficit. The drawdown in COMEX registered inventories in the West is occurring simultaneously with shrinking stockpiles in the East. Notably on the Shanghai Gold Exchange, Asian industrial demand, particularly from the green technology sector, is robust and drawing metal into bonded warehouses and manufacturing, channels that are less likely to quickly return to the liquidity pool of the London or New York markets. This creates a bifurcated dynamic where available floating supply is being pulled from multiple directions, tightening the noose on the global centralized vault system. It means that a shortage is not isolated to one trading hub, but is becoming a synchronized global phenomenon, reducing the avenues for arbitrage that institutions might typically use to source metal and relieve localized pressure. The investment demand side also presents a new variable. While the surge in retail buying of coins and bars in 2020 was notable, the current landscape includes a more entrenched form of institutional investment through physically backed exchange-traded funds. These ETFs represent a collective claim on thousands of tons of silver stored in vaults. These holdings are typically considered part of the available inventory, but they are functionally sticky. ETF shares can be traded, but the underlying metal is rarely disgorged unless investors liquidate the fund units on a large scale. This creates a reservoir of metal that is visible but largely immobilized, further reducing the effective float. A significant rise in price could trigger inflows into these ETFs, which would physically remove even more metal from the immediate trading supply as the funds purchase metal to back new shares, creating a self-reinforcing cycle. The regulatory and reputational landscape for the banks involved has also evolved. The era of 9-figure settlements, while costly, may have altered internal risk tolerances. The detailed trader communications released in litigation provide a public playbook of past tactics, increasing scrutiny from both regulators and sophisticated market participants. While the economic incentive to manage price risk remains, the legal and reputational costs of overt manipulation has arguably increased. This does not mean the tools are no longer used, but it suggests their application may be more nuanced, constrained, or reserved for what are perceived as existential threats to their positions, such as a clear breakout above a multi-decade resistance level. This change in environment could contribute to the decreasing effectiveness of paper-based suppression during routine market movements. Looking ahead, the interplay between price discovery and physical settlement will be paramount. The futures market's ultimate purpose is to facilitate the efficient transfer of commodity risk, and for some, the actual commodity. If the physical delivery mechanism begins to falter due to lack of metal, the credibility of the entire paper pricing structure is called into question. This could lead to a repricing event where the value of silver decouples from the futures-led benchmark and begins to track the true cost of securing immediate physical metal, which would be reflected in soaring regional premiums. Such a scenario would represent a fundamental breakdown in the current global pricing model and force a recalibration across the entire supply chain, from miners to manufacturers to end investors. Therefore, the narrative is not simply about a potential price spike. It is about the integrity of a market structure. The documented tactics of the past relied on a foundation of abundant, deliverable metal. That foundation is cracking. The coming period will test whether the existing system can adapt through increased transparency, perhaps by encouraging more metal into registered vaults via higher forward prices, or whether the strain will manifest in a discontinuous price move that realigns paper and physical values through volatility. For the observer, this translates to monitoring a set of concrete indicators: the relentless tally of warehouse stocks, The subtle shifts in the futures curve from contango to backwardation, the widening bid-ask spreads for large physical bars, and the commitment of traders' data that shows whether commercial entities are reducing their exposure or digging in. Each piece of data feeds into understanding whether the convergence between paper and physical reality will be orderly or disruptive. The mechanics are clear, and the tension is building within a system that was not designed for the current confluence of persistent structural deficit and declining liquidity. The outcome hinges on a simple, unavoidable principle in a commodity market. When promises and possession conflict, possession ultimately holds the cards